With California voters set to decide on Prop 22, the ballot initiative is now the most expensive in state history. The companies have spent a combined $202 million through October 29th for yes on 22. Uber and Lyft together contributing about half of that, $100 million bucks. Joining me to discuss just how high the stakes are for this ballot initiative, Alex Kantrowitz is founder of the newsletter Big Technology. Alex, it's good to have you. And I find your comments really interesting because you kind of say, look, the company should have gotten ahead of this. It's their fault that this is now kind of being ping-ponged back and forth to voters and now back to them. But we've seen a number of industries in California ask for and receive, I think musicians are the latest to receive exemptions from Prop 22. Doesn't that suggest it was a flawed bill?
Well, it's definitely a blunt instrument meant to solve a complex problem and certainly not a perfect one. But you got to ask yourself the question, how do we get here? And I don't really think this becomes an issue to the California legislature unless the drivers are not being treated extremely well. And I think that's what happened here. And I think the best form of regulation, if you're a company, is self-regulation. You don't want it to end up in the hands of the government. We've seen that a lot with the other big tech companies. And I do think that the fact that Uber and Lyft, DoorDash haven't paid very much for the services of the people that are working through their apps has sort of led to this moment. And now they're facing the cost.
I know you think, and I think for investors, this is something that should resonate. You know, the shares are up big the last couple of days in anticipation of today's outcome, but you think ride sharing faces a problematic future now regardless, especially because of COVID. Is that right?
Oh, my God, yes. It's such a rough moment for ride sharing right now. I mean, if you think about what's happened in the pandemic, people have gone from taking Ubers and Lyft all the time to buying their own cars, figuring out that meeting that you were going to take in person could be remote, and that trip to the office might not be worth it now that you're working from home. So you put that together, so the demand is down. And then you put that together with the fact that the autonomous driving that these companies were counting on is farther down on the horizon than they ever expected. And it's just a really difficult moment to be a ride-sharing company right now. It's hard to see a very promising future, at least within the next 3 to 5 years.
What happens if they're defeated at the polls? I ask that question because it looks like most expect them to win, in which case that preserves the status quo. What happens if they face a surprise loss?
Yeah, it would be fairly catastrophic for them. I mean, this is really their business on the line. Deidre has previously reported that, you know, in a moment where they thought they were going to have to take all the contractors and make them full-time employees, they'd actually have to shut down the app because it would be such a complex undertaking to figure that out. We might be looking at shifts. And, you know, they say that there's, you might see more than 100,000 drivers just in California get cut from the system just so they can figure out, a way to retain a segment full time. So it would have pretty catastrophic results. That's why they're spending all this money to try to defeat it. Like you mentioned, it looks like they're going to win on this front. But, the polls that I saw were fairly inconclusive. And so this is a fight that I expect to go on one way or the other.
Shepard Smith here. Thanks for watching CNBC on YouTube.